Hi and good evening, ladies and gentlemen. Welcome to tonight's webinar. So in this three-part session this evening, we will be discussing the implications of the Russia-Ukraine conflict. We'll be talking about inflation and the consequent rate hikes, as well as an investing idea in commodities that we believe is worth paying attention to. So there's a lot to get through tonight, and to kick us off, we'll start with Cyrus Ng from the IFAS research team, and he'll give us more information about the macro picture. Now, if you have any questions tonight, feel free to put them into the Q&A function, and our speakers will address your queries at the end of the sharing this evening. So without further ado,
Hi, good evening to everyone. Thank you for attending today's webinar. I'll start off with a brief overview of the Russian-Ukraine crisis and its investment implications. First, let's start off with a quick recap of the Russian-Ukraine war. On 24 February, Russia shocked the world by launching a full-scale invasion of Ukraine. And since then, the war situation has worsened over the past few weeks. UN estimates that 3 million Ukrainians have fled the country, while another 2 million are internally displaced within the country. And this has turned out to be Europe's largest refugee crisis since World War II, highlighting the severity of this war. While peace talks between Russia and Ukraine are still ongoing, a finalized peace deal remains very elusive. Both sides have said on paper that progress is being made, but there is definitely no clear timeline on any peace deal. And in any case, any deal will require compromises on both sides that they might not be willing to make. And as you can see from the graph on the right, global equity markets have tanked following the invasion, while commodity prices have skyrocketed. Russia is a key exporter of many commodities covering energy, metals, and agriculture. For example, Russia is the third largest producer of oil globally, while Russia and Ukraine together account for 25% of the world's wheat production. As such, there has been a disruption of supply for many commodities, leading to the price increase. As for equities, investors have shifted away from risk assets towards hedges like gold as a result of the war. Furthermore, with the broad-based increase in commodity prices, concerns are growing over the growth outlook for different countries, and this pessimism over the growth outlook has led to further weakness in equities. So since the invasion, Western allies have imposed multiple sanctions on Russia, on top of those imposed in 2014 following the annexation of Crimea. Harsher sanctions are always a possibility in the future if the situation continues to escalate. And the overall response from the West has been much more unified this time. For example, the West was very quick to implement a swift ban on Russia, targeting not only transactions by Russian businesses, but also Russia's central bank itself, limiting its ability to defend the ruble through FX interventions. In addition, Western allies have shown a greater willingness to target Russia's oil exports this time, with the US banning Russian oil imports outright, a marked departure from the 2014 Crimean annexation. Looking ahead, commodity prices may remain at elevated levels in the absence of any meaningful de-escalations. Western measures like sanctions and the SWIFT cutout will drastically affect Russia's ability to export commodities and receive payments for these exports. And the war itself may cause disruptions to the transport pipelines themselves, especially those going through Ukraine. Oil prices have seen a reprieve recently, but we caution against excessive optimism on this front, as any peace talks will take time to come to fruition and even more time for production to perhaps ramp up in countries like Iran. Therefore, overall, we do see commodity prices remaining elevated. As for equity markets, they are likely to remain volatile. Risk sentiment remains weak. You can see on the graph on the right. Volatility continues to persist in equity markets right now through the CBOE volatility index measuring volatility in US equities. And overall risk sentiment remains weak given this uncertain and fluid nature of the war, and markets will require time to digest higher commodity prices and its potential effects on inflation. We see two main impacts from this Russia-Ukraine war. The most direct impact will be on countries that just do a lot of trade with Russia. So Western sanctions will severely limit Russian exports and imports to its trading partners, while the SWIFT cutout will have a similar effect by restricting payments for trades with Russia. Amongst major economic regions, Europe has the largest trade links to Russia. But outside of Europe, there's little direct trade between Russia and the Western developed world, as well as between Russia and Asia as a whole. The second indirect impact will be this indirect impact on inflation. Commodity prices were already elevated pre-invasion due to supply chain disruptions and strong global demand. But if this military situation continues to see no resolution, we could potentially see a sustained period of elevated commodity prices in the months and years ahead. This has global economic implications, as central banks may then be forced to tighten policy further to rein in inflation. The global macro backdrop remains fragile as the world slowly emerges from COVID-19 and the Omicron variant, and further policy tightening will weigh on the global economic recovery. Looking at the US specifically, Russia only makes up about 1% of its total export value and 0.7% of its total import values. With such small trade ties between US and Russia, we expect little direct economic impact, though weakened risk sentiment should continue to weigh on equities. What is more notable for us is its indirect effect on inflation. US inflation recently hit another record high of 7.9% in February, and the Fed may be forced to aggressively tighten policy to bring down inflation. As my colleague will elaborate on later, we expect about 7 rate hikes in 2022, and such policy tightening may negatively affect the US recovery. As for Europe, Russia makes up about 1.5% of total export value and 2% of total import value, slightly higher than the US. But we note that within the continent itself, the smaller European nations, mainly the Baltic states, have a greater trade exposure to Russia, while the major economies like Germany have lower exposures. Therefore, we believe that the direct economic impact on the whole remains manageable, though similar to the US, weakened risk sentiment should again continue to weigh on equities. What we are way more concerned about is Europe's high energy dependence on Russia. Russia supplies around 40% of Europe's natural gas, while about 10 to 20% of the natural gas and crude oil transits directly via Ukraine itself. Overall, we do see room for energy prices to climb even further if Europe starts to target sanctions towards Russia's energy sector, or if the war disrupts gas flows through Ukraine. This can have a strong indirect economic impact on Europe through higher inflation levels, and the economic impact in the medium to long term will ultimately depend on whether higher energy levels are sustained or not. Finally, moving on to Asia. Asia is expected to remain relatively insulated from the effects of the war. Looking at the direct impact on trade relations, Japan and Singapore do not have major trade ties with Russia. Hence, the sanctions each country has announced are unlikely to have any material impact on their respective growth outlooks. As for China, Russia makes up around 2% of China's total export value and 3% of total import values. But overall, we again do not expect a significant disruption given the relatively close ties between the two communist regimes. Ultimately, on the indirect front, we think that weaker risk sentiment will again weigh on some Asian equities, especially Japan and Singapore highlighted there. But we believe that as for Chinese equities, risk appetite for Chinese equities are actually dictated more by domestic factors rather than international event like this war. And on the whole, the continued easing policy within China should overall be supportive of Chinese equities. Having talked about the economic implications, here's the question you've all been waiting. What should you do with your investments? The first thing to highlight is that we believe there is no need for investors to panic sell. Geopolitical crises are generally hard to predict and price in due to the fluid nature of each individual situation. History has shown that geopolitical military events tend to have a short-lived impact on markets. As you can see from the graph, in the Gulf War and Afghanistan War on this slide, and the Iraq War and Crimean annexation on this slide, you can see that, as mentioned, these events tend to have a very short-lived effect on global equity performance and recovers very soon after. And furthermore, we see that the fundamental backdrop remains very firm for global equities, with COVID-19 risk gradually fading due to higher vaccination rates and global earnings still remaining robust despite this war. With that being said, investors again should not panic sell, but they should also strategically position themselves for the bumpy ride ahead. We first want to stress the importance of diversifying your portfolio. A diversified portfolio, especially across asset classes, may reduce volatility during this period. In our opinion, Asian markets have lesser direct economic links and geopolitical exposure to Russia and the Russia-Ukraine war, while Asian central banks also generally have relatively more accommodative policy stances at the moment. We therefore recommend investors consider Asian ex-Japan equities right now for diversified Asian exposure, such as the two products highlighted there, the Schroder Asian Growth Fund and the iShares Core MSCI Asia ex-Japan ETF. Secondly, investors can consider strategically positioning for a trend of elevated inflation and rising interest rates. Again, we have a few recommendations, but broadly speaking, we recommend first commodity-related equities as a hedge. And the main reason is that commodity prices are likely to remain elevated, and commodities tend to do well in periods of higher inflation. And I think my colleague Chloe will discuss some products in a later presentation. Another suggestion for you is that you can also look to tilt your portfolio towards value sectors, especially sectors that benefit from a rate hike environment, such as financials. Finally, for your fixed income allocations, investors like yourself can consider reducing duration in fixed income. And what this means is that when you reduce duration, your fixed income holdings will ultimately be less negatively affected by any rate hike moves. Thank you for listening to my presentation today. I've covered the brief overview of the Russian-Ukraine crisis, and I look forward to any questions in the Q&A later, and will now pass the time on to Derjun.
Hi, good evening, everyone, and thank you, Cyrus. So my name is Derjun. I'm with the research team here at FSM1, and today I will be sharing with you our inflation outlook for this upcoming cycle, as well as some of the ways that you can position for it. So without further ado, let's begin. So before we talk about our forecast for interest rates, let us talk a little bit about inflation first and how we got here. So we see inflation as transitory. Those were the words that were echoed by Federal Reserve Chairman Jerome Powell since the beginning of 2021 as consumer prices started to rise alongside economic activity in the US. And in September, the first sign of trouble emerged when the central bank called inflation frustrating, noting that it was still sticking around longer than expected. Nonetheless, they were still expecting inflation to ease eventually. But fast forward to today, as you can see from the chart over here, the consumer price index is now sitting at a 40-year high of 7.9%. And the Fed has finally concluded that inflation is no longer transitory, and they have finally decided to retire this word. So initially, the Fed made the call that inflation was going to be transitory, mainly because they thought that the pandemic-induced supply chain issues were the main culprit behind rising prices in the US, and that these issues would eventually be resolved as the pandemic subsides. While this is true to a certain extent, putting an end to the pandemic has proven to be a tricky task, as you can see right here in our local market when the government just relaxed measures. The number of cases spiked. Same goes for Hong Kong and now even for China, where even China has such a stringent COVID-0 policy, but they've still seen cases rise from the hundreds to the thousands today. And right now, many cities are under lockdown. So the same goes for the US. So for the US, the country actually recorded a huge surge in new COVID-19 cases since the beginning of the pandemic in January this year, as it started to open up. And with a sizable chunk of its workforce out of action due to COVID-19, many businesses within the country have to contend with a slew of challenges, ranging from logistics delays to labor shortages. And on top of that, major US ports are currently suffering from one of the worst congestion in decades, which is partly due to the shortage of workers and truck drivers caused by the fast-spreading Omicron variant. So in January this year, ports in Southern California, which, by the way, are among the largest along the US West Coast, reported that roughly 10% of its daily workforce was unavailable due to COVID-19 related reasons. So these factors, coupled together with the higher fuel costs and shipping demand, have sent freight rates up by nearly tenfold since pre-pandemic levels. Now, at the same time, consumer spending in the US is roaring back to life, and it is stronger than ever thanks to the pent-up demand, generous stimulus packages, as well as the significant accumulation of savings across the course of the pandemic. And strong wage growth and rising home prices is also adding to household wealth, which further fuels the propensity to spend. Now, aside from the soaring goods inflation, as we already know, services inflation has also started to pick up, rising by 4.8% year on year in February this year, which is the most in over 30 years. And on top of that, shelter costs have increased by 4.7% in February as rents and home prices in the US continue to rise. So the thing is, throughout 2020, many renters, they were able to benefit from price reductions or even in some cases, months of free rent, courtesy of the eviction moratorium as well as the emergency rental assistance program, as many landlords struggled to fill empty houses. However, today, these concessions are more or less gone as the economy has bounced back and landlords are once again back to hiking prices as housing demand spikes. And given that shelter costs, it accounts for nearly a third of the overall CPI basket and its more structural nature, we think that there is a high probability that inflation will remain elevated for the foreseeable future. Now, moving on to something a little bit more recent, and that is the war between Russia and Ukraine, which of course made the inflation situation worse, sending commodity prices from food to energy skyrocketing. So as my colleague earlier, he already mentioned, both countries are among the world's largest grain exporters. And on top of that, Russia is also a major energy exporter and accounts for quite a significant proportion of Europe's energy supply. And as such, the conflict between both countries is likely to have an outsized impact on commodity markets. And with the Russia-Ukraine crisis deteriorating each day, we think that commodity prices will likely remain elevated, or worse, go even higher from current levels, which is a development that will certainly add to inflationary pressures. So taken together, these trends, they point to the likelihood that inflation is no longer transitory and will likely remain elevated for the foreseeable future. Now, moving on to our interest rate forecast. So right now, markets are pricing in at least 6 rate hikes this year, which would bring the Fed funds rate to 1.75% by early 2023. However, based on past rate hike cycles, it is observed that the market has largely underestimated the actual number of rate hikes that are conducted by the Fed. And this underestimation, it ranges from between 1% to 2% throughout the various cycles. So this time, with inflation at the highest level in several decades, and more importantly, showing no signs of easing, we think that there is a high probability that the Fed will have to tighten rates more aggressively than previously planned to tame inflation. And to that end, which again is under an aggressive tightening scenario, we project that there will be a total of 12 rate hikes occurring between now and 2023, with 7 of them in 2022, followed by 5 in 2023. So overall, this would bring the Fed funds rate to 3.25% by end 2023. And unless inflation numbers come down sharply over the course of this year and next year, and again, this is a scenario which we think is pretty unlikely given the current circumstances, as I've explained earlier, we think that investors should begin to prepare their portfolios for a higher interest rate environment over the next 2 years. So in a rising interest rate environment, investors with growth-heavy portfolios may consider diversifying their equity exposure to include more value-oriented sectors, such as financials, which are likely to benefit in a rising rate environment. And for exposure to financials, investors can consider two of our recommended products. The first is the BlackRock Rural Financials Fund, and the second is an ETF, which is the iShares Global Financials ETF that is listed on the New York Stock Exchange. Alternatively, you may also want to consider commodity-related equities as a hedge against inflation. So with the Russia-Ukraine crisis threatening to disrupt Europe's energy supply and food supply, energy commodity prices are likely to remain elevated. So and secondly, with much of the world shifting towards clean energy, mining companies, especially those that dabble in the precious metals or base metal space, may stand to benefit from this long-term trend of shifting towards sustainability. And to that end, our recommended fund for commodities exposure is the JP Morgan Global Natural Resources Fund. Alternatively, investors can also consider the BlackRock World Energy Fund. Next, investors can also diversify their equity exposure to markets that have relatively attractive valuations, such as Asia ex-Japan, Japan, China, or even Taiwan. So Chinese equities in particular have been beaten down by a number of issues, such as the trade war that started in 2018, and more recently, the tech crackdown that occurred between 2020 and 2021, which left many of these Chinese tech companies' valuations at relatively more attractive level compared to their peers. And on top of that, monetary policy in China is also expected to be a little bit more accommodative, which should support its equity market. So for China, our recommended product includes the iShares Core MSCI ETF that is listed on the Hong Kong Exchange, as well as the JPM China A Fund. And for Japan, investors can consider the JPM Japan Equity Fund or the iShares MSCI Japan ETF that is listed in the US. Now, in terms of single stock picks, investors who are looking at single stocks during this time of high inflation and perhaps rising interest rates should look to avoid highly leveraged companies, as they could face difficulty in refinancing their debt. So companies without pricing power, such as those that are unable to pass on the increased cost to consumers, should also be avoided. And lastly, for fixed income, investors should aim to reduce duration to protect against a faster than expected rate hike environment. So short duration bond funds, such as the Nikko AM Shenton Short-Term Bond Fund, as well as the Lion Global Short Duration Bond Fund, are two products that you can consider. And before I end, while aggressive rate tightening policies generally lead to a period of lackluster return, we think that investors who position themselves properly and early may find that their portfolios are performing better than the market. And with that, I've come to the end of my sharing today. I wish you all the best in your investing journey, and I'll now hand the time over to my colleague, Chloe.
So hello everyone, thank you for joining us for this webinar. My name is Chloe and I'm an equity analyst from IFAS. And for today's session, we'll be sharing with you more about how the Russia-Ukraine crisis and rising inflation has actually brought about a commodity super cycle. So tensions between Russia and neighboring Ukraine have erupted into a full-blown invasion. On 24 Feb, President Putin announced the launch of a military operation against Ukraine, and Russian forces fired missiles at several cities in Ukraine, as well as landed troops on its south coast. So Russia's invasion of Ukraine poses profound risks to the global economy, which is already suffering from soaring inflation as well as supply chain disruptions. Moreover, amidst this geopolitical conflict, oil prices have reached a new high. Both US and global benchmark oil prices have recently touched their highest level since about 2014. So Brent crude oil prices actually surpassed $100 per barrel on 24 Feb, and this is the first time again since 2014. So amongst all these uncertainties, we will shine a spotlight on the commodity sector. So Russia's invasion has several implications because of the fact that Russia is a country that is so resource rich. Russia is the world's second largest oil exporter and supplies about 40% of Europe's natural gas supplies. In view of Russia's actions against Ukraine, the path towards a de-escalation of conflict becomes increasingly challenging. Not to mention, beyond that of oil and gas, Russia is also amongst the leading producer of metals such as aluminium, nickel, copper, and iron. The country is also largely involved in the export and manufacture of other essential raw materials like palladium as well as platinum. So sanction-induced supply chain disruptions would further drive up the prices of these metals. Moreover, just the day before the invasion, US had already imposed sanctions on the company that was in charge of building Russia's Nord Stream 2 gas pipeline. So this was a pipeline that was designed to double the gas flow capacity from Russia to Germany in order to ease the pressure on European consumers that were facing record energy prices. Germany had also halted the Nord Stream 2 gas pipeline approval, and naturally, the halting of such a pipeline would mean a supply-side disruption for that of Europe. While the US and its allies had initially stopped short of imposing sanctions directly on Russia's energy exports, we find that the situation has swiftly changed. So on 8 March, President Biden actually signed an exclusive order to ban the import of Russian oil as well as natural gas and coal to the US. The order also bars new US investment in Russia's energy sector and blocks Americans from financing companies that invest in this sector. So where it stands, we think that US is still likely able to stomach this ban due to their strong domestic energy infrastructure. But Europe might find such a ban especially challenging, and this is because of their reliance on Russia's energy exports. Nevertheless, as these tensions continue to further escalate, we actually anticipate more of such sanctions to actually come. Not to mention, for the first time since the invasion of Ukraine, Russia has actually threatened to weaponize its energy exports, and they will do so by cutting the natural gas supplies to Europe via the Nord Stream 1 pipeline. And this is in response to some of the sanctions that they face. As such, level of geopolitical risk premium may well be sustained for some time, given the market concerns over the possible effects of any supply chain disruption. Prices are expected to remain volatile and rise from current levels if these geopolitical concerns do not ease. And at the backdrop of all these geopolitical tensions is that of inflation. So as my colleague mentioned, inflation is now running at its highest in a generation, with consumer prices now rising by nearly 7.9% in February on a year-on-year basis. And this is following a 7.5% annual gain in January this year. And this is the highest inflation recorded in nearly 40 years. So combined together, rising inflation as well as these geopolitical tensions have no doubt created a commodity supercycle. So in a high inflationary environment, we tend to find that commodities typically outperform. And there's a strong 10-year correlation of 0.73 between the year-over-year growth of the Bloomberg Commodities Index as well as the US CPI Index. And this highlights the effectiveness of using commodities as an inflation hedge. Moreover, given Russia's role as a commodity superstore, the economic impact of this crisis could further worsen the current global inflationary dynamics. Commodity prices are expected to remain at elevated levels in this current environment, and this makes commodity-related equities a decent hedge in one's portfolio. And despite the recent volatility, we find that the rationale for investing in commodities still remain intact. And I will do so by explaining this is due to the growing demand-supply imbalance. So this imbalance can be observed in the oil and gas as well as the metals market. So when we look at oil and gas, we find a case where fossil fuels have actually fallen out of favor with the whole investing universe, given many ESG considerations. And this actually posed a major challenge for a sector that badly needed new investments in order to keep up with the growing demand. So in fact, annual investment in upstream oil and gas actually peaked at about 780 billion in 2014. In 2021, the annual investment in upstream oil and gas amounted to only 351 billion. And this is despite the fact that the world is still consuming near record amounts of fossil fuels. So currently, nearly all the energy which is needed to meet our demands, 80% of the global energy actually comes from burning fossil fuels. Thus, for now, renewable energy is actually unable to replace fossil fuels in order to meet our energy needs. Not to mention, the vast oil surplus accumulated during the first few months of the pandemic has also been wiped out, with inventories of OECD countries falling. Going forward, weak supply from OPEC will further worsen this demand-supply imbalance. So OPEC seems reluctant to actually stray from its current deal and is sticking to existing policies of a moderate output increase of about 400,000 barrels per day. And this comes after having reported that several OPEC members have actually struggled to pump even in line with their quotas due to years of underinvestment as well as large maintenance work that has been delayed by the COVID-19 pandemic. So currently, crude oil demand is about 97.8 million barrels per day, but yet supply is around 92.2 million barrels per day. So this gives a shortfall of around 5.6 million barrels today. And barring Russia's supply side disruption, as many countries have imposed sanctions against Russia and refused to accept their energy imports, we see that this demand and supply gap is actually expected to grow and remains very, very large. Hence, the prospect of these depleting inventories, as well as the limited investments within this oil and gas sector, in the face of the growing demand, will only mean that the current imbalance persists and will further push up oil and gas prices. Not to mention, we see this similar issue occurring within the metal space. So in particular, the demand for green metals, which are those that are used in applications as well as processes that enable this energy transition from fossil fuels to cleaner energy sources, have actually far outpaced demand. So the ongoing clean energy transition to actually combat the ill effects of climate change has released this huge demand for metals, requiring as much as 3 billion tons. So copper, lithium, cobalt, and nickel are tightly linked to the electric vehicle and energy storage sectors, and they're seeing their demand rising exponentially. So S&P Global Market Intelligence have even forecasted that their demand is actually expected to grow at a CAGR of 15% for copper, 35% for lithium, 28% for cobalt, and 35% for nickel by 2025. And we find this unsurprising, given that the largest economies of the world, such as US and China, have actually pushed stimulus plans that are targeted towards these clean energy and renewable energy infrastructure. So where it stands, the lack of supply has already sent these metals prices surging. And in spite of all the recent attention that has been garnered by this commodity sector, we still find that the energy as well as material sector remain one of the cheapest, especially in the MSCI AC World Index. And they're also trading below their long-term average valuation multiples. And all in all, this actually creates a rather attractive investment opportunity. Moreover, as seen in the figure here, the energy and material sector, they offer one of the most attractive dividend yields among the various JIC sectors. And the companies within this sector, they actually focus on returning cash to their investors. So for instance, the material sector has a 12-month forward dividend yield of 3.66%, while that of the energy sector has a 12-month forward dividend yield of about 4.68%. So all in all, as investors actually consider the possible inflation and growth shocks to the global economy from these geopolitical conflict, as well as the anticipating sanctions, they can actually seek shelter from in the commodity sector. So with this in mind, we recommend the JP Morgan funds, which is that of the Global Natural Resources Fund. And this is a fund that, again, invests in natural resource companies, such as those involved in oil and gas, as well as those involved in metals and mining. Other than that, you may similarly consider the BlackRock World Energy Fund, which is involved in that of the if we have companies involved in that of the energy sector, if they are perhaps looking for a more dedicated energy fund. So to end off, we believe that both these funds are actually well positioned to benefit from the global commodity super cycle. And with this, I actually come to the end of my presentation. So thank you once again for your kind attention.
All right, and thank you, Chloe. And we will be back shortly to, our speakers will be back shortly to take your questions that have been raised. Feel free, of course, to add yours in the Q&A function. Now, just right now, I'd just like to take this opportunity to highlight to you this promotion that we have going on at the moment. So as you have noted, there have been some funds and ETFs mentioned by our speakers. And these basically, they'll help you to position your portfolio strategically against volatility and inflation. So for this limited time period, until 31st March, you can receive up to 40,000 FSM rewards points when you invest in these funds and ETFs. So later on, I'll put the link in the chat section for you. You can click on it and head over to the article where more details are contained within. Okay, so here's the second thing that I'd like to also show to you. So this is our a link basically to our FSM1.com research Telegram group. So if you've liked reading about the coverage of our various markets, as well as the sectors and opportunities you can capitalize on for your investing, then you can consider joining this Telegram group. And then this way you won't miss out on our articles. Okay, I'll just leave this up just for a moment so you can scan the QR code. And later on, I'll paste the link as well. And so when you click on it, you'll be brought over to our channel on the Telegram app. And then we hope that you'll join us there. And whenever an article comes out, you'll be notified. Once again, if you have any questions, feel free to add them into the Q&A function. And shortly, I'd just like to welcome Cyrus, Dajin, and Chloe back. And they'll begin to take your questions.
Hi, thanks to everyone for asking so many questions. We'll start off with one from regarding the likely scenarios and probabilities of different endgames. So I think broadly speaking, there are two scenarios, but as I'll elaborate later, they roughly have similar outcomes. So I guess the first scenario is that we get a peace deal. And you might think everything seems good, right? We get a peace deal. But that doesn't mean that after a peace deal, everything just goes back to normal as if the war didn't happen. Because for one, we have to consider that both sides will need time to come to an agreement in the first place. And even in this positive scenario, we may only see the exact details of this type of deal emerge after many months of negotiation. And in any case, even if we get a positive outcome, sanctions are unlikely to disappear immediately. So for example, if you look at the 2014 Crimean annexation, sanctions from that time are still there. The current sanctions are just on top of those sanctions. And if we look at Iran, sanctions have been there for 20 years, on and off, based on different US precedents, but they're still there. And this time we see that the response to Russia has been so strong and unified. And this shows the determination of the Western world to pretty much send a message to Russia that they will not back down even if they get a peace deal out of it. And what this means, ultimately, is that even though we might see resumption of commodities exports from Russia, the situation will ultimately still be changed. So Russia's trade will likely still be disrupted if some sanctions continue to linger on. And for example, the import ban on oil from the US, and ultimately this should mean that commodity prices remain elevated. Now, in the other scenario where you don't get a peace deal, we have to bear in mind that Russia still has some cards in its hand. For example, it can preemptively cut off its energy supply to Europe and perhaps the rest of the world. And in such a scenario, this would plunge mainly Europe into a very serious energy supply crunch. And in this worst case scenario, some analysts have called for a price target of $200 per barrel on Brent. And this doesn't seem unlikely if Russia really chooses to opt for this sort of nuclear option. And in this case, Europe again will be hit the hardest through energy inflation and its effects on companies' profit margins. But overall, to answer your question, what are the effects of the different endgames is similar in that we'll likely see commodity prices staying elevated, perhaps at current levels, perhaps to higher levels of $100+ dollars per barrel for oil. And what this means is that central banks should also likely remain on this tightening stance, especially as inflation was already high before this war. So two things will happen, and they will likely remain the same at different severity. First, higher commodity prices, and second, this central bank tightening and rate hikes. Okay, I guess I'll move on to the next question. If Chloe and Tajin, do you want to chime in on the previous one?
No, actually, Cyrus, maybe I'll take the question on China first.
Okay, sure.
Yeah, so there's a question. With China's recent outbreak, what are your thoughts on the equity market despite the cheap valuation? So I think the issue with China right now is that the market is largely traded based on investor sentiment rather than fundamentals. So for the tech sector, for instance, it has been through a world of hurt since 2020 with Donald Trump's trade war, tech war, and more recently in 2021, the crackdown on the Chinese tech sector. Yeah, but I think these issues are playing a role in the overall equity market valuation. And on top of that, I think just over the weekend, the US also said in a statement to its European allies that Russia actually asked China for military assistance for its war in Ukraine. So that also added to some fears that investors, that the US might levy sanctions on Chinese companies, which caused the steep sell-off on Monday and Tuesday. So I think right now, if you are thinking of investing in Chinese equities, fundamentally, I would say Chinese equities are pretty attractive given that earnings have risen to more than pre-COVID levels already. So I think valuations are at one of the all-time low levels across recent history. So from a fundamental perspective, I would say Chinese equities definitely attractive. However, the issue here is it really has to do with investor sentiment and whether or not you are able to stomach the kind of volatility that we have seen over the past 3 days. So you can expect, I mean, given the wild swings in the market, I think it's not impossible to think of a scenario where Chinese equities can go up and down by more than 10, maybe even 15% on an intraday basis. So that is something that you have to consider if you are thinking about Chinese equities. A short word on delisting. So recently, the US is also threatening to delist, I think, 5 or 6 Chinese companies from the US exchanges. The thing about delistings is most of the major US companies, major Chinese companies that are listed in the US, they are actually dual listed in Hong Kong. So for example, Alibaba is one, and there are still many other companies that are also listed in Hong Kong. So in the event that they are delisted, and assuming that the shares are fungible, so what these companies can do is that they can simply swap their shares for the USD ADRs for their Hong Kong dollar shares, and they can continue trading on the HKEX. And on top of that, the US, although it is the largest equity market in the world, it is not the only equity market in the world. There are plenty of other places to list your shares. Hong Kong is of obvious choice. And in China, there's also the Star Board, which is a newly created board, relatively newly created board that accommodates to young startups, high growth companies. So that can be a potential destination for Chinese companies to list their shares as well if they are in the unlikely event booted off US exchanges. And the last thing I want to touch on is the crackdown on the Chinese tech sector. So across 2020 and 2021, we have seen major crackdown on Chinese tech companies. Alibaba is one of them. The Chinese government stopped Ant Group's IPO. They investigated Meituan. They put restrictions on children's gaming hours, which negatively affected Tencent. However, one message that they have reiterated multiple times before is that these crackdowns, they are not meant to deter the growth of Chinese tech companies, but rather the main intention here is to ensure healthy competition and sustainable long-term growth. So think about it, like 20 years ago, when these companies are just starting out. They were very small, they were very young, and what China did was actually to ban Western companies from operating in China. So you don't see Google in China, you don't see Facebook in China. So Chinese companies, they largely have no competition, which enabled them to grow to the size that they are today. However, with that kind of influence that they have today, with many consumers and small businesses relying on these apps or these products created by Chinese companies to go about their daily life, their influence has clearly gotten too big. And therefore, we think that a regular dose of regulation is perhaps not unhealthy or otherwise could be needed. Yep. So I think that's basically some of the main points for our take on the Chinese market.
Okay, I'll answer some of the questions with regards to oil. So I think somebody asked why oil price recently dropped. So the reason why oil price recently dropped is actually due to the ongoing peace talks between that of Russia and Ukraine, as well as the fact that there's an Omicron outbreak in China, and China has a zero COVID policy. So essentially, the Chinese government actually locked down Shenzhen. So what this means is that China is one of the largest crude oil consumer. So in the case of lockdowns, as well as a slowdown in economic activity due to that of COVID-19, naturally the demand for oil will drop. But we don't think that this demand for oil will remain low for a long time, as we in fact see that the pickup will come rather quickly due to the fact that this Omicron variant is a much milder variant. And so we'll see that demand returning very soon, and not to mention economies around the world are actually opening up and more people are going to travel. So we see that this demand for oil will remain strong. And so this currently, where the oil price recently dropped a bit, we think that this is only temporary, and the long-term trend for oil is actually going to remain elevated. And also, there's another question on how would surging commodity prices affect EVs. So in the case of EVs, they require metals such as lithium and also copper. And currently we see that there's a severe shortage when it comes to this metal supply. So we think that with this shortage in terms of these green metals, which are needed for this EV transition or clean energy transition, we could feel that the transition will perhaps take more time, and hence in this such an event, right, we actually rely more on fossil fuels. Right. So Cyrus, would you like to take some of the questions?
Yep, sure. There's a question on the possibility of stagflation and the effects on growth. So I think for this issue of stagflation is clearly something that's popped up much more in the past week or two. But I think it's important to separate stagflation based on perhaps the country or the region. So we start with Asia. So overall in Asia, inflation so far hasn't been as elevated. For example, if you look at Singapore, core CPI, we do not see levels like the US 7.9% or Europe, which is I think about 5%. So in terms of the stagflation, the growth outlook for Asia is still relatively positive. Yeah, sorry, they're in the midst of reopening after a relatively late vaccination schedule. And yes, overall, we will unlikely see this part of stagflation in Asia because they are expected to see robust growth alongside the broad reopening of economies. But moving on to the more contentious regions. So first we look at Europe. So we feel that the risk of stagflation is highest in Europe. So as mentioned in my presentation, Europe has one of the largest trade links to Russia and is very energy dependent on Russia. So, but nonetheless, it's still too early to say for sure whether there is stagflation or not. I think one consideration you have to bear in mind is whether Europe fiscal support will be larger than expected or not. So Europe's ECB still has tools in its kit. For example, it can perhaps implement a subsidy on gas prices in the short term to reduce wholesale prices for firms. We have heard the US releasing its reserves, countries around the world releasing their reserves to alleviate these high oil prices. And yeah, so there are many factors that could still alleviate oil prices in the short term for Europe. And I guess another consideration is whether Russia will weaponize energy prices. So just now we talked about how fiscal support might help push down energy prices, but Russia on the other hand can push up energy prices by just banning oil exports. So those are two conflicting situations that could happen in Europe, and ultimately how likely stagflation is in Europe depends on which situation happens. And right now it feels like stagflation in Europe does seem like a relatively possible scenario at the moment, especially with ECB revising inflation forecast upwards and growth forecast downwards. But it's still not a done deal for sure, and it's not a high probability scenario by any means, but it's definitely something you should watch for in Europe. So sorry, and last region is the US. How high is the possibility of stagflation there? So in US, the inflation trend is pretty obvious, again 7.9% in February. But the good thing about the US is right now, growth is relatively healthy. With that being said, there is still a decent possibility of stagflation, lower than Europe, but higher than Asia. And this will mainly come from policy errors. So markets are expecting 6 to 7 rate hikes for US, and there's a chance that if they hike too much or hike too little, this could really have a very big effect on equity prices. And if they hike too little, in fact, if we see inflation going up even higher, it could affect asset prices and company earnings in general through affecting their profit margins. And for the US, apart from affecting profit margins, we have to note that when inflation goes higher, it affects consumer spending as well, because companies will pass on this higher cost to consumers. So right now, with high inflation and high growth in the US, stagflation is less likely than Europe, but do not count it out yet, because if inflation keeps staying at these high levels, we still could see stagflation in the US.
Okay, perhaps I can take the next question. There's a question on the semiconductor industry. When will the chip shortage issue end? So first of all, this shortage is a perfect example of the pandemic-induced supply chain issues that I talked about earlier. So when the pandemic hit, many businesses, they actually cut their orders for semiconductors, thinking that demand is going to be affected. However, as we have seen, this pandemic is not as deadly as like SARS, for instance, and the economy bounced back rather quickly. And this also means that many of these people who cancelled their orders, they didn't manage to book them again, and this caused a shortage and a rise in chip prices. So shortage is usually measured using something called lead times, which is basically the difference. The time difference between a client placing an order for a semiconductor and to the day that they receive them. So right now, chip lead times are about 26 weeks, which is, to give you some perspective, 26 weeks is actually a lot higher than normal. So pre-pandemic levels, the lead times is about 12 weeks. And lead times have started to rise as the economy started to recover in 2020 and 2021. Driven by many trends such as digitalization, the use of cloud computing, 5G, so on and so forth. So all these trends, with more companies adopting digital technology, cloud computing, cloud server demand has been increasing, and that has also put pressure on chip makers to produce more chips. And on top of that, a lot of people are buying cars also, and automakers, they are increasingly using more chips inside their vehicles. So electric vehicles, for instance, has much higher silicon content than traditional combustion engine vehicles. And that has also contributed to the sharp rise in the demand for chips. However, seeing that chip times have risen this much already, although the pace has slowed slightly, we think that there is a good chance that chip lead times could go down in the future. And the reason for this is because when chip lead times are this elevated, there is some evidence of double ordering. So what double ordering is for example, I'm a client. I'm quite kiasu, so I want to get this part and I don't want this part to hold up my entire production line. So what I do is I place multiple orders with different clients for the same part. And eventually, when time comes, I realize that, hey, I actually don't need these parts, then I'll cancel the orders. So right now in the market, there's some evidence that double ordering is causing the inflation in chip demand. And this is something that is cited by chip makers also. And they are trying to actively work out and investigate whether the people who are ordering chips, do they really need it now, or are they just buying to hoard chips? So to that end, I think that the chip shortage, it has a good chance of resolving itself, hopefully over the next half a year or so. But on top of that, I think the long-term growth story of semiconductors is pretty simple to explain. So think about it. Nowadays, we use all the electronics that we use, everything inside them has semiconductors. And if we think that the world is going to be increasingly tech-driven, increasingly digitalized, then demand for these semiconductors will only continue to grow. And I think that basically sums up the long-term growth story for semiconductor companies.
So maybe I'll take the question on how much higher commodities could potentially increase. So in terms of this, we think that oil could possibly reach $150 per barrel, as what I mentioned earlier, mainly due to this severe demand and supply imbalance. And also when we look at the situation now, it does share some similarities with what has happened in the oil markets back in 2008. So in 2008, the oil prices actually reached a record high of close to $150 per barrel. And back then, the demand for oil was also growing rapidly, especially amongst developing countries such as China and India. And also back then, there were many geopolitical tensions, such as an Israeli attack on Iran in June 2008, which also caused this huge spike in oil prices. So we see that there are a lot of similarities between what has happened back then and now, and coupled with this growing demand-supply imbalance, which we think is not going away anytime soon, and also the fact that OPEC is actually struggling to increase their production, as many of them lack sufficient capacity, and this is mainly due to the years of underinvestment. We think it's possible that oil could go as high as $150 per barrel, just like what has happened in 2008.
Thank you. Next question is regarding the announcement that Saudi is looking to trade oil with China in renminbi. And what's the effect on USD currency? I think ultimately we don't expect any major long-term impact on USD currency and equity markets as a whole. First, because while I think Saudi sells 25% of its oil to China or some, I think it's around there. But in the grand scheme of global trade, it's not, the renminbi still accounts for a very, very small percentage of transactions compared to the US dollar. So while some people can see this as one step towards de-dollarization, we think that such a trend would need many steps, considering the really sheer dominance of the USD when it comes to international transactions worldwide. So ultimately, we don't see any long-term impact on markets in general, both on the USD FX side and equity markets. And yes, so I guess the next question is on sanctions being used as a club and Russia's reserves being frozen, will it lead to a rise of other currencies alternatives being used? Again, yes, this could lead to a trend towards de-dollarization, but in any case, again, the dollar is very, very dominant, and we don't see that dominance going away anytime soon, just simply out of convenience. We think there's a reason why people use the US dollar, and people trust it for whatever reason. that is just a currency that can be used anywhere around the world, unlike, let's say, any other currency. So the thing is, there aren't any major competitors out there that really can be a credible competitor to the USD right now. So the euro is not. The euro has been out for 10, 20 years, but it has not emerged as a true competitor on the global scale. I think in terms of transactions, they're only at most more dominant in their ex-colonies. But in terms of overall global trade, they are nowhere close to the US. Again, partly due to the dynamic nature of the US economy. And another alternative that China has been pushing is their own renminbi. But again, that has its own considerations as well, because the PBOC's policies are, I would say, relatively more opaque and hard to deduce compared to the Fed's policies. They tend to be more, I guess, inward-looking in terms of trying to toggle their policy for their own internal benefit. So, yes, with the renminbi, with the PBOC, I guess not showing that it's ready to take up the lead in terms of being the dominant currency, and very few countries willing to use the renminbi at all for any transactions outside of China. We think that our currency alternatives may rise, but in the next few decades, the USD will still be the dominant currency for trade worldwide.
Okay, thanks, Cyrus. So there's a question on higher interest rates, inflation, supply chain disruption, and commodity shortages, and basically the impact of these things on Singapore's economy. So I think in general, like I've mentioned in my presentation, there are certain sectors that should do well in an inflationary environment, in an environment where interest rates are expected to rise. So one of them is financials. Financials mainly because they make their money based on net interest margins. So if you can set a higher interest rate for your loans while paying lower interest rate for your deposits, then typically banks can stand to benefit. That's how banks benefit in a rising interest rate environment. So the second thing is also, as Singapore's economy is gradually reopening back to full strength, and eventually I think that also travel restrictions will also be eased. And in an inflationary environment, certain REIT sectors, they can be a good hedge against inflation also, and can be also a good play on the cyclical recovery of Singapore's economy. So one of the REIT sectors that have been lagging behind and could potentially do well in the event that the economy goes back to full reopening is hospitality REITs. So I think among the various subsectors of REITs, hospitality REITs are one segment that hasn't done too well, given that travel restrictions are pretty much still in place. So this is one sector that could do well. Another sector, retail REITs also, as the economy recovers, life goes back to normal, the demand for retail space may increase. And another area that I think is pretty interesting is also the data center REITs. So Singapore, we have a couple of data center REITs. I think those could be good plays also when not just following the economic recovery, but also the digitalization of not just Singapore, but also the rest of the world. Then companies that could be less affected, basically these companies, and those companies that are more affected would be the companies without pricing power. So this question is really quite specific, so it really depends on the companies on their own. And I would say in general, Singapore being an open economy, a very trade-reliant economy, I think higher prices worldwide is certainly going to affect us. So I think from figures that are published by MTI, you've seen inflation slowly creeping up already. And that could be the case also if these supply chain issues persist longer than expected, or hopefully not, but if the war in Ukraine gets worse, then we might see inflation being elevated for quite some time, and that will trickle down to prices in Singapore as well.
Okay, so I'll take a question on how China announced that they'll produce all the coal that they annually, how is this going to impact coal prices? So currently, coal is one of the most polluting in terms of energy resources. And the fact that if China is going to produce all their coal they require internally, we don't really think that it has going to have a major impact on coal prices. So in terms of energy, coal is not really being used by European countries due to its very heavily polluting nature. Whereas natural gas as well as crude oil is more commonly being used. Yeah, so in terms of this, we don't think it has a huge impact, and also such actions could actually be a setback to China's move to actually go green.
All right, thank you, ladies and gentlemen. You've been a wonderful audience tonight. Thank you for your good questions. Stay tuned to fsm1.com as we continue to provide more updates for you, as well as fresh investing ideas. This is all we have for you this evening. Once again, if you have a bit of time, do head over and check out our the current promotion that we're running at the moment, and also click on the link to join our Telegram in order to get the latest updates on our articles. We wish all of you good health as well as a successful investing journey. So take care and good night.